Hi guys, I'm back, and in today's sharing, I will be talking about this expectation on flipping properties in 3 years' time. I know the last 3 to 4 years after COVID has been quite crazy for probably a lot of asset instruments out there, including property, where you see even double-digit price growth, like in 2021, you have over 10% growth. So I'm not too sure if people are treating this, benchmarking this as the norm when they're looking at property investment these days. Because I've been in this line for more than 10 years. I think if one is expecting properties to be flipping properties like this every 3 years, they might be on the wrong track, having the wrong mindset and expectation altogether. It is quite common now. I mean, even agents and even clients asking me, Zavier, what can I buy that can make money in 3 years' time? I'm thinking of flipping it, right? I'm not too sure they're on the right track. So I've seen in my years of experience how property go up, gyrate up and down. Of course, in the long run, they tag with inflation and the GDP growth. I mean, they go up. But having this expectation that you can make double-digit growth in a year, I mean, of course, being compounded by leverage and exiting in 3 years' time with an easy exit strategy, I'm not too sure if that is the right expectation there. So in today's sharing, I'll be touching on this and actually how to really look at property investment the right way. So first up, over here, you see this time series chart that I took from URA. Okay, the green line shows the property price index in general from non-landed residential pricing. Of course, it has been going up since I took from 2000 all the way up to this year. Now, and then the blue color line, you can benchmark it to the y-axis on the right. There is a percentage change in property price index for each year. That's why just now I mentioned after COVID in 2020, you see in 2021 to 2023, there is a good increase in the property price. But anything above 5 to 10%, if you're looking at the last, you see over here, last 23 years, you realize that it is quite out of the norm. Usually the most number of dotted lines you can see in the chart right now, the line between the -5 or 0% to 5% growth. I think that is the normal expectation. All right, so you can use this as a gauge and see how maybe in the last 3 to 4 years, I mean, you can look at it as a bonus or you can look at it as an anomaly, but certainly not as a norm moving forward to always expect double-digit price percentage growth every year. All right. So let's now talk a little about the characteristics of property as an investment. Now, why this is important is because you really need to know what property is all about and how you can really look at it and then fit it into your retirement portfolio, your financial planning, your nest egg, right? So first up, let's talk about cons. I've talked a lot about this. The main issue about property is the illiquidity side of it, right? You cannot just buy and sell a property by clicking the button as compared to stocks and shares. In fact, just purely factoring seller stamp duty altogether, you need to have a good wait of 3 years before you can sell, unless of course you can exit at a very good price and then you can factor your seller stamp duty into your price. So that is the illiquidity side of property. Now, number two would be it being very capital intensive. Now the loan to value has always been decreasing ever since, right? You got 90% back like 15-20 years ago, and then it's dropped now all the way to 75%. So it means that your cash and CPF down payments are more these days. So it's 25%, you add on your stamp duty of 3 to 5%, it's a good 30%. Even though you're using CPF, it is still your money, and together with cash, it is quite intensive at the start. Now, if you compare this with the other kind of investment instruments, where you can just buy on a monthly basis up to $100 of a certain, stocks or whatever ETFs, right? 30% of at least a $1 million property is certainly more capital intensive. Okay, number three, I think would be the very low returns as compared to other asset classes. But of course, high risk, high return, low risk, low return. So the risk is lower, the returns are lower, and you must really understand that you cannot expect it to double or to make a certain amount, that's why I talked about it earlier, right? You must really accept that Singapore property per se, the returns are always lower, but at the same time, you get stability. Last one will be the upkeep costs. I think it being a physical asset, we're talking about maintenance fee that you're paying, and then of course over time some repairs that you need to do, right? So these are some of the upkeep costs that other asset classes you don't really need to pay for it. Okay, so these are the cons of property. Now let's look at the pros of it. Yeah, but I feel that liquidity is actually like a double-edged sword. Now, it being too liquid, sometimes when the markets are very volatile, when it goes up and down crazily, I still remember just in the last COVID, wow, when the market dropped by the limit down at 10% in the US market, yes, you can be, let's say, a long-term value investor holding strong companies, but it can get too emotional. Now, if you're not in control of your emotions, by the fact that it being very liquid and just pressing the sell button, it may do you more harm in that sense, right? So property, when it's illiquid, it actually takes out the emotions out of this purchase, right? You can't just, when during COVID, you just can't sell it, out of nothing, out of emotions altogether. So it can be a pros too. Point number 2 of it is that there's some safe leverage involved. Now, of course, probably now the loan to value, it's definitely lower. So, and because of total debt servicing ratio and all these MAS requirements that actually just wants the borrowing to be very prudently done. So you're looking at Singaporeans, PRs, they're actually taking loan that they can really afford to. Not because that they want to speculate. It's just very stringent to take a loan. So in that sense, the leverage is very safe. And when you're looking at Singapore owning properties, even HDBs, I think we got over 90% of home ownership. Almost all of us takes a home loan, right? So in that sense, if everyone is doing so, it's also quite safe. And that's the reason why the borrowing cost is also very low. Yes, we had a spike 1+ year ago, up to 4-point-something%. But just for information, the loan rates are actually as low as 2.8 for fixed rate now. So you can't, I don't know, you can't, at the time of such high inflations, you can't possibly get such cheap financing. In fact, I can tell you a lot of business owners, they actually gear up their property, as their property get paid down and the property value goes up. They do a gearing up equity loan out of their property because the loan interest is although it's a gear up, it's always based on the mortgage interest rates, right? So you can get 1-2+% back then, and then cash out the money and then use it for their business. But if they're going to get just a pure business loan per se, I'm pretty sure it is upwards of 5-7%, right? So in that sense, it is a very safe form of leverage. Okay? Number 3, I think it would be the point of it having utility. What do I mean by that? It's a physical asset that you can see it, you can feel it. A home that we go back to live, right? To work, to sleep in it, definitely. And then even if you're looking at office spaces, industrial spaces, these places that we work from, places that we can store things, right? So there's utility you can use, there's use out of it, as compared to buying gold, for example. If you're going to compare gold and real estate, gold, there's no real utility out of it other than a store of value as a safe form of hedge to maybe currencies or things, right? So the utility function, I feel is very important because you can use it for different means, and of course you can rent it out. And COVID really emphasizes the need for a roof over our head. That's the reason why residential property outshine the commercial industrial properties in Singapore. Okay, the 4th point will be on diversification. Now, when you're buying a physical property in Singapore, you're kind of betting for the country to do well, based on its economic growth, its GDP growth altogether. As compared to, let's say, a particular stock and share in a specific industry. Let's say if you're buying a bank, you're betting on the banking sector, you're buying a healthcare stock, tech stocks, or whatever consumer products. It is based on that specific sector, right? So it is more specific for that particular instrument. But when looking at property, especially in Singapore property, you're really betting holistically that the entire country will do well. So on that note, you kind of have more diversification. Okay, the next point about it, it's having more transparency, just by the pure fact that you can see it, you can feel it, you can assess it, right? As compared to other products out there, whereby maybe the information is not so ready and transparent, maybe an overseas property, I don't know, land banking, some kind of scheme, or even other stocks and shares in different countries where the information, the publicly available information might not be clear. It might even be wrong. Okay, so it's not as transparent. I like the fact that in Singapore, the properties are there for you to feel, touch. The information by URA, it's all available. Okay, the next point, I think all of us will understand this. I think it's the purest hedge to inflation. In the last few years, we've encountered that. And if you're looking at really the core inflationary products, right, the inflationary services, you're looking at manpower costs, you're looking about like raw material costs, and all these kind of things, these are the building blocks of a property, right? You're looking at sand, metal, iron, aluminium, you're looking at construction workers, you're looking at cars, oil, everything. These are all fundamental building blocks of a physical property. So if all these things are all going up, property price would definitely be going up. So on that note, it's definitely a very good hedge to inflation. The last point, I think, for Singaporeans especially, it's a very good legacy item, right, that you can leave for generations, especially if it's something, that it's more than 99 years. People love it, freehold 999, that you can continue to live. It's a real hard asset on that same note too, a very good legacy item. So after looking at the pros and cons of property as an investment class, when I put all of it together, I think it can kind of help you form the right approach to how you can look at it. As for me, I really look at it, and that's how I advise my clients. It must be a holding horizon of at least 5 to 8 years. Yes, I know you can flip upon 3 years, there's different exit strategies, but anything shorter to me is actually a bonus. You should always prepare for 5 to 8 years horizon, because inherently, Singapore properties are just meant to be held as longer term. Okay? Now, on that note, because it is longer term, slower growth, but safer, it will form the majority of my retirement nest egg. Okay, and it happens to be in Singapore, the values are all very large, right? Even a HDB now, 1 million property, it's not uncommon, right? So as the value becomes bigger, it will actually forms the majority of your nest egg. And I'll actually make a purposeful commitment to build and elevate this asset class up to 5 million. It sounds a lot, but once, people who are already staying, owning a landed, you're already there. Those that below are starting with a HDB, it's always a work in progress, right? The earlier you start, the better it is. Why a 5 million? I think it's always good to at least put somewhere a bit higher to attain. And we're looking at 5 million, it's a combined asset of the husband and wife. If let's say you're married as a couple, if you combine your property value, you should try to at least hit this 5 million mark. Especially now with inflation, the value of money is getting smaller and smaller these days. The other approach also is to really assess your portfolio. You see, when you're holding it for this longer term, it's not just to just chuck it down there and not look at it, right? There are certain opportunities that comes onto the market. Like for example, after COVID, you can do this short-term flipping, right? And also, based on your own needs and your own capability, at a certain point of time, you may have certain funds of wealth to actually do more elevation, more upgrading of your property. So it's always good to always assess it and not just put it one side. All right. Lastly, I think you should really look at it by, in terms of building for retirement, at the same time, how it can be used as a passive income stream in the future when you're not working, right? Simply by just renting out, one of the properties, and then yielding you maybe a 2 to 3 bedroom at around 5 grand, that can be a good source of passive income when you're retiring. So when I just put all the different asset classes together, I mean, this is just my point of view, right, in this pyramid. For me, real estate, I mean, endowment, CPF cash, fixed deposit, government bonds, and golds, this form the base and the majority of your wealth as you reach age 65. Anything above, they're more speculative, short-term, more risky. Then, of course, your percentage are lesser. So I just put it in a very nice pyramid over here for you to understand. And again, this sharing is just gives you an overall, view of property as an investment. Just because I just want to touch on it, since everyone is talking about flipping for every 3 years, which I don't think is a very realistic expectation. But of course, everyone's needs are different. If you have any questions regarding your situation, please, just PM me and I'll take it from there. All right, thanks for your attention, and I'll see you for the next one.